Well, welcome, everybody. My name's Mark Littlewood. I'm the Director General here at the Institute of Economic Affairs. Thanks for joining us for this joint Institute of Economic Affairs Taxpayers Alliance briefing on what's been one hell of a fiscal event day and a mini budget day. I'm joined by three guests on the panel who'll be making their own observations about Kwasi Kwarteng's mini budget shortly, but just to remind you of some of the headlines and talk you through how this event will work. Total tax cuts of 45 billion by 2026 to 2027. The government has wedded itself to a growth target of 2.5% a year. Not completely obvious to me at what year that's supposed to kick in, but getting back to higher rates of long-term growth, as widely trailed not just by the government in recent days but by Liz Truss in the Conservative leadership campaign. The planned rise in corporation tax has been cancelled and the national insurance hike has been reversed. That will kick in from November, that reversal. The stamp duty threshold has been raised. The highest 45% rate of income tax has been completely abolished. The reduction in the basic rate of income tax, which was due to take place in April 2024, has been brought forward to April 2023, perhaps giving the room for a further cut before the next general election. The cap on bankers' bonuses has been completely abolished. The Chancellor insisted that it has actually had no real impact on overall bankers' remuneration. Quite a few supply-side reforms hinted at, sketched out in the mini-budget today. Details to be filled in the coming days and week. Investment zones, the kind of enterprise zone concept, the Chancellor says there may be up to 40 of those across the country. Not quite clear yet what total amount of geographical or GDP area they will cover, but there will be special regulatory and I think tax compensation in those zones to encourage growth. All looks pretty good, I think, from a free market point of view, with one rider, the deficit. If you're a deficit hawk, you might have a few concerns here. The total cost of the energy package over the next 6 months is going to cost 60 billion quid or so. And in terms of balancing the books, it does feel a bit like manana. I'm going to ask each of our guests for just in a sentence before I ask for their presentations what they thought of the budget. So let me introduce each of those in turn. Delighted to be joined by Andrew Lilico, economist and IEA fellow. Andrew, welcome. What's your one-sentence analysis of the budget we heard today?
Exciting but overblown.
Exciting, overblown by the media or by the government?
By the media.
By the media. Duncan Simpson?
Some great supply-side changes, but we should be worried about the debt.
And Julian, what was your take on today's announcement?
A big gamble, but one I think will pay off.
Okay, there you go. Fairly positive reaction. A lot of people are calling it a gamble. Let me tell you what you're going to hear from each of our guests. We've got for those of you watching on YouTube, we've got a live audience here in the room. I'll be trying to take questions from them in about 20 minutes' time. And if you're interested in asking a question on YouTube, just put it into the chat and someone will direct that to me. Andrew's going to tell us about his dynamic tax modelling. I'm going to give him the floor for about 10 minutes. Oftentimes these immediate spot price analyses of budgets to show you who's gaining or losing what as of tomorrow, assuming there are no sort of second round effects, that people don't change their behaviour. Andrew's trying to crack that problem for us and give us an idea of what the benefit might be of some of these. Julian, I'm then going to ask to talk about the note of concern that you voiced, Julian, debt and borrowing, how worried should we be? And then Duncan, Research Director at the TPA, international comparisons and growth rates. We're going to hear for no more than 10 minutes from each of them. I should say, if you run to those 10 minutes, then the combined total of you three speaking will be longer than Kwasi Kwarteng was on his feet for. 25 minutes, pretty action-packed budget today. But Andrew, welcome. Perhaps I can give the floor to you to talk us through your dynamic tax modelling.
Indeed.
And I think
there's
put that on the
slides about to come up.
Yep.
Perfect. Great. So I'm going to tell you a little bit about the impacts of the mini budget. First of all, so if you go to I had a couple of slides. There we go. So first of all, just to remind you of what some of the announcements were, as was said. So there is this reduction in the basic rate of income tax and the top rate abolished. Those are perhaps the ones that will make the most headlines. There is the cancellation of a 6% rise in corporation tax, interestingly described as a massive fiscal stimulus by various bodies. I mean, since that's the cancellation of something that didn't ever occur, it occurred to me to wonder whether if Kwasi Kwarteng had announced £200 billion of tax rises at the start of his speech and then cancelled them at the end, that would have been an even bigger tax stimulus. But anyway, then there's the cancellation of the social care levy, which was, so what happened, if you recall, last year there was an increase in the NI, both employers and employees, and that was supposed to be replaced. They were all automatically coming off next year anyway and being replaced by the social care levy. That's just being cancelled altogether, and the NI rises that occurred are just coming off straight away. The biggest, most significant thing really is this energy price package. They estimate that will cost 60 billion over the next 6 months. That is, of course, a guess, because it depends entirely on what happens to international energy prices, and that depends on what happens to the Russia-Ukraine war and all kinds of other things which they have absolutely no control over whatsoever. So their complete guess at that is 60 billion pounds over the next 6 months, and they have this long-term GDP growth target of 2.5%. So those are some of the key things to remind you of. So if you go back one, so the exercise that we're engaged in here is, as Mark was saying, a lot of the stuff that you'll see about the budget, there's some rather crude things. In fact, some of them even just focus on the tax measures and haven't even incorporated what the spending measures were, even though it's so large. You see, there was what was it? Rachel Reeves, I think, put out a "This is a disgrace" tweet with the breakdown of the tax gains, which contained the amazing information that wealthy people pay more tax than poor people. So when you cut taxes, then rich people get more pounds out of that than poor people. I'd never known that before, but apparently that's so. But what we're doing here is thinking about the question of what happens to the growth rate of the economy over the medium term. And another dimension of that is, going along with that, as well as thinking about what happens to the growth rate of the economy over the medium term as a consequence of tax changes, what does that mean in terms of what we might think of as a recycling rate? So if you impose some taxes and that means that the growth rate is lower, then you're going to lose some taxes as a consequence of that, because you're going to lose on other kinds of tax. If you cut taxes, maybe you don't get as much revenue out of that tax, but if that leads to the economy growing faster, you may get higher tax returns from other sources. So you have this recycling rate about what's the net effect of these. So we're thinking about that. The way that we do that is within a standard growth model framework. Those of you who are unfortunate enough to have done a master's degree in or above in economics may remember something called the RCK. I don't know why he was written S there, but anyway, RCK model, Ramsey Cass Koopmans. It's a model by two people called Cass and Koopmans, who accidentally reinvented a model by Ramsey from 1928 without knowing so in the 1960s. So that's a standard workhorse model. We've added in some aspects of that model, made it a bit, done various fancy things, and this includes, we then impose, there are 4 different categories of taxes: capital income, wage income, expenditure, and corporate taxes, business profits taxes. All taxes are forced into one of those 4 boxes, and we assess what the effects of those will be over the medium term. Down 2 slides, please. Thank you. So that's a reference slide. We can come back to that in the question. So one more, please. So what are those impacts? The impacts that we find are that GDP growth as a consequence of the package of measures described today is 0.3% on annual on average, faster after 10 years than it would have been otherwise. Now, one thing to think about that is that's not so much that it will be 0.3% faster than it's been. And another thing to bear in mind is that most of that, about 60%, is not taking growth off by having a huge corporation tax rise. So much of it is not impeding growth through such a large tax rise. The recycling rate, that thing I mentioned, is about 75%. So you get three quarters back in terms of the tax as a consequence. That estimate there doesn't assess the impacts of the various other things, so this isn't assuming that the government gets very far with its other supply side measures, which are intended to get the underlying growth rate to 2.5%. if you were to do that, that would make considerable further changes. And a last thing to say, so I don't use up too much of the time for now, happy to take questions, is that the fiscal impacts are highly uncertain. Very difficult to guess because, as I said, the largest measure here is the energy price package, and the energy price package is highly contingent upon energy prices. So they estimate that it'll be 60 billion over the next 6 months. It could be twice that, it could be half that. They don't really know.
Can I just ask you a question before we move on to Julian then? So you're saying the impact is 0.3% on annual GDP growth after 10 years. Seems on the face of that, the government's got a hell of a long way to go to get anywhere near this 2.5%, right? I mean,
well, that's okay. So it was 1%. So what that's doing is, instead of it going, as it were, to 0.8, it goes to 1.1.
Okay. So we need. Am I doing my maths right? 4 or 5 similarly radical budgets to this one to get us to 2.5. You think?
If you were looking at these sorts of measures, but better measures for enhancing the long-term growth rate are not likely to be fiddling around with the structure of taxation. It's not that it does nothing. It's part of an overall package, but changes to the planning system, better regulation, new trade deals, and all of those kinds of things are likely to have more effect on that.
Andrew, thanks very much. We'll come to more general questions about that presentation and the budget shortly. I'm now going to give the floor to independent economist and IEA Economics fellow Julian, perhaps to highlight on one of the worries here, Julian, and just to introduce this. Some of the debates I've done on television and radio today have been almost the exact flip side of the arguments we had when the Conservatives first came to power in 2010, where folk of an IEA disposition were saying we've got to absolutely get the budget deficit under control as a priority, and this means cutting public spending, and our friends on the other side of the ledger, more state-orientated, left-leaning, you might say, people were saying, no, can't possibly do that yet, that would strangle the economy. This time round, the likes of Polly Toynbee and Anne Pettifor were telling me that they saw this is outrageous, we need to balance the books as quickly as possible. I'm feeling a bit schizophrenic about my media appearances over the past 12 years, but I'm hoping, Julian, you can tell us on the debt and borrowing side, how hawkish or dovish do we need to be, and how relaxed or worried do we need to be? Because a good number of folk are pointing out the concerns here.
Well, it's a good point. I mean, I sort of feel I've been on a bit of a journey myself here. I'm pretty certain that when I actually started work at the IEA, one of the first things I was doing was writing papers about the importance of balancing the budget from year to year, and even if that meant very big and immediate cuts in public spending. But I think I've changed my view on that, and I think that's one of the key themes of today's announcement, sort of relentless focus on economic growth instead. I think part of the problem is we have probably been too obsessed about short-term targets for government borrowing, particularly government borrowing in cash terms, and not thinking about the longer term burden of debt measured to the size of the economy. So if you can borrow more money in the short term, but that's done in ways that help to boost growth over the longer term, then they can actually lower the burden of debt relative to GDP. And that's very much at the core of the government strategy. I do have concerns, though, about that. I think that, I'm a tax cutter, but I don't believe that tax cuts alone are going to be enough to get growth to the 2.5% target. The good news is, though, that I'm pretty convinced that Liz Truss and Kwasi Kwarteng recognise that there's already quite a lot of good stuff on the supply side, and the sort of structural reforms coming through as well. Everything from IR 35, which is a disproportionate regulation on the taxation of self-employed people that's probably pushing many of them out of the labour market. Lots of other things, the stuff we're perhaps more familiar with on planning laws, for example. So lots of good supply side stuff. I was also actually encouraged by the willingness today to take unpopular decisions that potentially are a gift to people on the left. So things like scrapping the banker's bonus tax and lowering the higher rate of income tax for the top earners from 45% to 40%. Those are things that I don't think will play well in the polls, but again feed in well to this sort of supply side agenda. They're sending a very positive signal to any business that wants to invest in the UK. So how worried I am about this debt problem? I am worried. I'm not panicking. I think one particular thing to watch over the coming days and weeks will be the reaction in the financial markets. Initially, the financial markets have responded negatively to this. The pound has fallen further against the dollar. It's still the case that a lot of that is to do with the strength of the dollar across the board, because the US central bank is raising interest rates more aggressively and the US economy is less exposed to the energy crisis in Europe. So the pound actually hasn't fallen that much against other currencies like the euro and the yen, but there's undoubtedly a bit of nervousness there in the currency markets. Biggest move, though, of all has been in long-term gilt yields. So that's the cost of government borrowing. And that has shot up a lot. Again, a lot of that is part of a global move, as central banks around the world have started raising interest rates and reversing quantitative easing. But the move has been a bit bigger in the UK than elsewhere. That's not necessarily a bad sign. It might simply be a reflection of the fact that because the economy is stronger, then interest rates are going to be higher, and we're sort of rebalancing away from tight fiscal policy, loose monetary policy, towards a better mix of looser fiscal policy and tighter monetary policy. But if bond yields did keep rising, then I would be more worried about the levels of debt that we have. But as long as it's part of a coherent macroeconomic strategy, which I think this is, so boosting growth to improve the finances, public finances over longer term, as long as it's backed up by lots of sound microeconomic reforms on the supply side, then I do think, as I said earlier, this is a big gamble, but it's a gamble that's worth taking, and I do expect it to pay off.
Julian, let me just ask you a quick follow-up question before I bring Duncan in from the TPA. From what I can judge, there doesn't appear to be any measurable appetite to have a comprehensive spending review or look at areas of government state spending that could be radically reduced at the moment. That's just going to be allowed to I think, glide for a while. Do you think that should have been part of this statement, that they were going to look vigorously at areas of public expenditure that they could reduce, slash, or are they right just to take a fairly relaxed view on the government expenditure side of the ledger? Because obviously you could reduce the deficit if you were to be bold there and actually look at areas of state spending that you were willing to cut.
Well, I think you need to be realistic here. I mean, the new team's only been in charge for a few weeks, and part of that was interrupted by the mourning period for the Queen. But in that time, they've already done an amazing amount of things, not necessarily things everybody's comfortable with, but the energy price guarantee, that was a massive policy change. What was announced today, I think, again, is a lot more than people were expecting. So almost sort of one thing at a time. I also think now will probably be the wrong time to be signalling big cuts in public spending, because we are sliding into a recession. I think at the moment it's right to be thinking more in terms of stimulating the economy rather than holding it back in any way. But equally, I think you're absolutely right that we can't forget about the public sector, public spending side of the ledger completely, and the whole host of things, largely around things like health and pensions, which are to do with the aging of the population, where big changes will be needed to prevent debt from running out of control over the next 10, 20, 30 years. But I think that can wait, maybe until next year, or maybe the most controversial elements of that could be included in the manifesto for the next election to make sure there's a clear mandate for doing that. But for now, at least, I think the priority was clearly to support the demand in the economy and boost the supply side, rather than tackle those big longer-term problems in public spending.
Julian, thanks very much. We'll come back to you shortly, but let's bring in our third panellist, Duncan Simpson, Research Director of our friends around the corner at the Taxpayers Alliance. Duncan, you're going to say a few words about international comparisons and growth rates here. These are always rather difficult when they're sort of thrown at you in the midst of a kind of 4-minute radio discussion that somebody will sort of say, well, what about Sweden? What about Germany? They've done things differently and it's worked 0.2% better. But what lessons do we have to learn from international comparisons on growth rates? Are we pursuing a UK-only sort of strategy here, and have other Western economies or economies similar to ours found a better way to tackle these sort of pressures?
Well, the news does look sort of a baseline scenario without the changes today, and you're pretty much near the top of the pile I think Japan, maybe one or two others as well, post quite a few of these changes. So basically we put as much as possible through that model, with the exception of the enterprise zones and a few other things which are just very technically difficult to put through. That transition, you've got the purple one, so the UK is basically sort of top of the pile.
And just so I'm clear on this shows from today over 10 years how much you're anticipating GDP per capita to rise by.
Exactly. So
so you were saying that in Britain it was going to go up by about 12%, and you're saying in light of these changes, or most of them that we've been able to compute, it will go up slightly north of 15%.
Yeah. So we for model sales that's about 12% to about 15.5%. So it wasn't terrible how it was beforehand, but it certainly improved materially. We hope from what was announced today. Probably the second one. So again, not dissimilar showing here. So top of the pile of the Swiss doing their wonderful things as well. You're really not really noticing too much change till about 3 or 4 years after these measures are implemented. Of course, what would be more helpful sort of beyond that is looking sort of 15, 20-year period. Some even better dynamic effects to sort of come from that. Obviously, there's a lot more to be done. Obviously, this mini budget will be only 25 minutes. Packed in quite a lot, but I think this shouldn't necessarily be a cause for any degree of complacency. But the initial output from our model is all good stuff.
And he's basically managed to shift us from that green line you can see to that purple line. That's right. That's the improvement we've seen today on that graph.
Exactly. So per capita, we're looking at around 44,500 GDP per capita. It's around $51,000. So that's quite a material improvement. Next one, please. So corporation tax. Now, obviously, this quite rightly was trumpeted by the Chancellor earlier today. So we're sort of maintaining the current rates rather than sort of bumping up to about 25%. Now, in comparison to a lot of other, these are all G7 members. We're already in a very good place. We're also in a relatively unique situation in the UK in that corporate tax is done on an entirely sort of central government basis. It's a reserve matter. It's nothing to do with devolved administrations. You've got all these sort of decimal points here for other countries because you've got local authorities who have a say in terms of implementing that. So that kind of continuation is good. Obviously, the important matter is a difference between sort of the marginal effective rate as well as the headline rate. So that incorporates things like various allowances, the annual investment allowance, so various types of reliefs, which then has a material impacts on the overall marginal rate. I'm not quite sure what the Italians are doing there with that number there, sort of minus 30. But the UK is in a pretty decent position compared to.
So in top of class, you might say, right? At least on the headline rate.
Headline rate, yes. In terms of effective rate, it's about middle of the pack. So obviously that doesn't incorporate what's happening today, but that's sort of the state of play in the UK at the moment. And so the final slide, if we could. And then part of the reason for that is that the corporate tax system in the UK has gone through quite a few changes. I mean, corporation tax wasn't introduced until 1965. Before that, you had a few allowances. I think the Victorians introduced a few of those, and they've gone through various iterations. So in the 80s, for example, you could do a thing of an allowance was allowed if you kept a piece of equipment for more than, I think, 25 years. Some very substantial changes actually introduced under Gordon Brown, curiously enough. With the annual investment allowance, so that's gone through, I don't know, must have been 6 or 7 changes over the years since that came into force in 2008. And obviously today we got that confirmed that the what was supposed to be a temporary position of £1 million for the threshold is to be continued in the new financial year. So that's the long and the short of it. But I mean, as was alluded to with Julian just now, I mean, it's pretty important that the spending side of the ledger is addressed at some stage. Obviously, within that document, there will be some allusion at the next fiscal event in terms of how spending will be changed. But if we look at the bigger picture of what was announced in the autumn budget last year, you had huge outlays of pretty much every department had massive outlays in high amounts of spending. Capital expenditure was increasing quite a bit. Public sector net investment, so government buying things basically. Huge increases announced a year ago, and that hasn't yet been changed. So as and when the full budget comes around, and presumably a spending review, then one hopes that's something the government is quite attentive to.
I'm just going to ask each of you one question each, then I'll take some questions from the audience here in the room, and I've got my eye on the YouTube chat as well. I'll fire a few questions from there. Andrew, can I start with you? Because the one suggestion that's been put to me, and I'm not sure I answered it very satisfactorily, has been Is it a fair criticism, or at least observation, to say that His Majesty's government policy, forgive me, old habits die hard, is pushing in one direction, whereas Bank of England policy in the other? That interest rates you might expect to continue to rise. We saw a rise yesterday. Might one take the view that the government's policy and approach here is potentially inflationary? More money in people's pockets, all things equal, would tend to be an inflationary measure, and that the Bank of England, who suddenly seems to have discovered something approaching a mini hawkish streak, will therefore continue to jack up interest rates very substantially over the next 12 months or so?
Well, I think it's a mistake to think of fiscal policy and monetary policy as geared at the same thing, such that if they're going in opposite directions, then they're pulling against each other. Rather, I think one of the weaknesses, and it's a classic criticism of having an independent central bank, is that it can be difficult to coordinate monetary and fiscal policy. And sometimes what you want to do is to change the balance. So I think that for some time we've had, in relative terms, probably a bit too tight fiscal policy and a bit too loose monetary policy. In fact, probably quite a lot too loose monetary policy. And that us now having the opportunity of these events to change that balance is a very positive thing. Part of the way in which the Bank of England would have achieved the reduction in inflation was by inducing a fairly significant recession. The recession, most of the inducing of the recession, of course, is down to Vladimir Putin and the energy price effects, but the recession would have borne down on inflation quite a lot. One of the consequences of having this fiscal boost is that you don't get so much recession. If you don't get so much recession, then you need to do more of the work of getting the inflation down by having with tighter monetary policy. But that's exactly what we want. We want the interest rates to be up back to a more normal level. In a healthy economy, they'd be between 4 and 5% most of the time. Unfortunately, we're unlikely to get them back to that anytime soon. We may get to 3 to 4 at peak here, and perhaps they'll go down below 3 again as the cycle turns. But what you want over the medium term is to get back to that. If we achieve if in 10 years time we've got to the 2.5% annual GDP growth rate over those 10 years that Truss's government wants, you should expect that interest rates will have gone back to 4 to 5% on average over the cycle. So that's a desirable, that's not a bug. The consequence of the loosening of fiscal policy results in higher interest rates is a feature. That's exactly what we should be wanting to happen at this time.
Julian, slightly on the same theme, inflation in particular, how concerned should we be about that? I know that there's a suggestion that the energy price freeze policy will bear down on it. But has the government still got a colossal problem here? Friedrich von Hayek, of course, famously said that, once inflation's out, taming it is like trying to catch a tiger by the tail. Is that a problem that they've still got, or do you think this can self-correct in a relatively smooth fashion?
Well, start with the positives. Obviously, the energy price cap means that the peak in headline inflation is going to be a lot lower than it might otherwise have been. I mean, we're just under 10% now on the consumer price measure. That will probably peak at around about 11% in October, and then drop off pretty sharply next year. Remember that some people were talking about inflation maybe going above 20% if energy prices hadn't been capped. So that's clearly a positive. Another positive is that a lot of the pressures from what's happening in the global economy are starting to go into reverse. So there have been big falls in commodity prices, including more recently the price of natural gas. But in many other commodities as well, including things like shipping costs, which I think is important. And also what we're seeing in terms of weaker economic growth around the world. I mean, it's not a positive in other respects, but some of the demand side pressures are easing. So I think there's a good chance that inflation will fall very sharply next year. But there's no reason to be complacent about inflation. If you look at underlying inflation, I don't really like doing this because it often means stripping out the things that people are most worried about. But if you exclude food and energy, then underlying inflation or core inflation in the UK is still running at around about 6%. And because of the years of very loose monetary policy, we still got an enormous amount of excess money hanging around in the economy, and inflation expectations are far higher than they need to be. So I agree actually with Andrew that it is desirable interest rates continue to rise in order to correct that period of very loose monetary policy and to continue to bear down on inflation expectations. In terms of where interest rates end up, I mean, my numbers might be a coincidence, not almost exactly the same as Andrew's. I think the new normal should probably be between 4 and 5%, but we won't get there, not least because of the very high levels of debt in the economy. I mean, that a given increase in interest rates probably has a bigger impact now than it might have done a decade or so ago. So I think interest rates will probably peak between 3 and 4%, but the process of getting there isn't necessarily a problem. I mean, if you look at those countries that have very low interest rates, countries like Japan, that's because their economies are stagnating and they have no inflation at all. So I don't think rising interest rates are necessarily a bad thing if it's driven by stronger economic growth and fading fears of recession.
Come to you because I think we've been generally, myself, the three of you have been broadly supportive of what the government's come up with, but as I was explaining in this very room a couple of days ago to IEA colleagues, I'm the sort of guy who won't take yes for an answer, right? So even if I sort of warmly welcome some of the measures made, what opportunities were blown here? I mean, would you have liked to have seen, for example, a substantial increase in the income tax thresholds for when the 40p rate kicked in rather than the abolition of the top rate? I'm not saying they're exactly equivalent. I've been banging the drum for a reduction in VAT, not necessarily a tax that is one of the more pernicious, but would it bear down on inflation if it went into reverse? There was no VAT cut here, nothing interesting on business rates, for example. Do you think there were a couple of open goals that the Chancellor could have slotted the ball into the back of the net, or is that just getting greedy at this point?
Not about greedy, but I think some of the big structural changes, business rates is one that you allude to. Obviously, within our movement, there's a big debate of introduction of land value tax as a replacement for that or some other iteration. That's somewhere further down the road, I think, if the government wants to engage with that. As I was saying earlier, though, I think yes, it is likely the case that a spending review will sort out quite a few of these issues, but that they've gone through this pretty heavy radicalism today, I really hope that happens quite soon from the government on the spending side. I mean, let's think about foreign aid again. I mean, it's not tenuous to, even though obviously Rishi Sunak had this sort of temporary reduction in theory, it's sort of going back to the previous level, serious cuts on that. A huge sway to the benefit system as well, just haven't really been revisited, and they're just being tweaked time and time again. It's part of government spending called annually managed expenditure, which means it basically just has to happen, pensions and so forth. And I'm not saying you have to scrap the state pension or anything like that at all, but a serious look at what is, for generations, been seen as sort of automatic bits of spending the government needs to seriously think about now.
Andrew, you wanted to come in very briefly on that, and then I'll come to the floor. So if anybody here wants to ask a question, make sure you catch my eye and I'll come to you. I think we've got a microphone just at the back. So
I think that you should consider it very positive that the government is saying nothing on spending, because they've stuck with the 2021 spending envelope. They've said they're not having any spending review, and that's exactly the right thing for them to do, because what that means is that inflation erodes the real value of the spending, and the consequence of having any kind of review of spending would mean spending going up in line with inflation.
Because the starting point would be match inflation.
That's right, exactly. Right. So the less they can say about spending for now, the better.
Okay. Any questions from the floor? Yes, if you just wait for the microphone, which is two behind you, and introduce yourself, that would be great. That will allow those who are watching us on YouTube to hear you.
It's Tim Wallace at The Telegraph. Thanks for the presentations. On financial markets, obviously I take Julian's point that the pound's been falling quite a bit this year, interest rates have been going up, but specifically today, markets do seem to have freaked out after the announcement, a big rise in bond yields particularly. Do markets, traders, investors lack faith in tax cuts, lack faith in the programme? Well, you obviously see it relatively positively, but they don't seem to. Interesting question. Julian, I'll start with you. I'll take feedback afterwards. I can see Ben Ryder in the YouTube comments that says, apparently, I'm entirely relying on Ben's accuracy here, sterling now trading under $1.10. He says, thoughts on this? I think the FTSE's gone down somewhat. Is this the flotsam and jetsam or the acid test of government credibility?
Well, I used to work in financial markets, and I'm pretty familiar with how investors respond. They basically hate uncertainty and change. We are seeing a major shift in economic policy, which perhaps in some cases hasn't been as explained as well as it could have been. I know many people in the city are nervous about the fact that the Office for Budget Responsibility, didn't publish a full forecast alongside the statement today. I'm not sure what that full forecast would really have added, but there are doubts about the credibility of the new framework, and in those circumstances, UK assets, particularly the pound and bonds, are likely to underperform. 2 points against that, though. One is, I think it's important to get the scale in context. If you look at what's happened, for example, to UK government bond yields, they've basically risen to the same level as yields in the United States. Now, perhaps that's a signal that we're going to start growing relatively strongly, more like the United States economy, rather than the sort of stagnation that we're seeing in Europe. The second point to make is that markets are fickle. I mean, clearly, UK assets are out of favour at the moment. But if this is indeed the right economic policy to pursue, as I think it is, and you start seeing the benefits over the coming weeks and months in terms of a better economic performance and better results from companies, more inward investment, all that sort of thing, then I think sentiment towards the pound and the gilt market can turn very quickly. And just on top of that, sentiment is so negative at the moment that's often when you're about to get a big turn that, I think anybody who's going to dump UK assets has now surely already done it. And there's scope for what in the jargon is known as quite a large short squeeze. So I wouldn't be surprised if the pound is a lot stronger by the end of the year. And also that sentiment calms down in the bond markets, which is where I think it really matters. After all, don't forget, if the pound is weaker, then that does create some winners in terms of the boost to export earnings as well as losers. It's more the rise in bond yields I think we should be worried about, and hopefully that's just a return to more normal and sustainable levels.
And Andrew, what's your view on this? Again, when I was sort of the slightly discombobulating feature of some of the radio interviews I've done today have been the people up against me suddenly discovering that the market reaction should be considered gospel in terms of analysing whether these policies are rated as good or bad. What do you think of that? They're a pound down a bit. I think the FTSE's gone down a bit. Are these measurements that are, are these vital, or are these sort of rounding errors?
I don't think they're vital. I think that some of the focus on them goes back to an era when there were fixed exchange rates, and if you'd lose the ability to maintain your exchange rate if things came under pressure and all of that kind of malarkey. Look, what happens in financial markets is quite complicated. Some of the movements are going to reflect the fact that the Bank of England didn't raise interest rates as much as was anticipated yesterday. So there were a lot of people who thought it was going to be 3/4 of a point and it was only a half point. The Bank of England also said that we were already in recession. So you've got those sorts of factors as they start to become more absorbed, and people, it doesn't get challenged, so people become more confident that's right. I suspect there is an element of concern, particularly about the open-ended nature of the energy price package. Just saying, it's 60 billion over 6 months and we don't really have any plans for exiting it. What happens if energy prices double or triple from here? Then the government's fiscal exposure is absolutely enormous. So I think there are some genuine concerns about that. But at another level, there really wasn't anything fiscally significant in the mini budget today, fiscally significant.
45 billion of tax cuts.
That hadn't already been announced.
Right.
So it's very unclear why there would be any market reaction other than them finding out that Truss actually did what she said she was going to do. So I think, but I think it is reasonable it's not. They have some concern, I think, that there's a sort of populism. You hear people going on about, switching from Singapore on Thames to Venezuela on Thames, or that kind of language that gets overblown amongst financial market participants. But the reality here, if you think about the things that they did, stuff like the banker's bonus cap removal, or the removal of the top rate of tax, are very strong signals that they're willing to do very unpopular things. So the characterization of them as just, they're cutting taxes and whacking up the spending, and they're just surrendering completely to populism in the hope of winning the next election. I don't think that's a correct characterization of them, but it is reasonable for a new incoming government to have to earn its credibility. So the financial markets are testing, and over time, if the government manages to execute well and produces something, things will come back. I mean, markets do what markets do.
Slight twist on this point, Duncan. What did you think of the OBR not being asked for their independent assessment here? You might say that that's the government worried about being properly scrutinised. Similarly, in some of the arguments seem to be sort of treating the OBR I don't know, a bit like VAR on football, as if this is sort of an absolute scientific judgment of whether the government have scored a goal or not. Whereas, of course, there's independent analyses of this budget anywhere and everywhere. I mean, we're providing one at the moment, so it didn't seem to me that was a particularly obvious way of avoiding scrutiny. But what did you make of them saying, no, actually, on this occasion, we're not so interested in publishing your thoughts?
Didn't really seem to bother me too much. The usual process is that in the lead-up to a budget, it's a 10-week process. The OBR ordinarily needs 10 weeks. I think in 2010 with the coalition government, that was a 6 weeks process, and that was done slightly quicker than ordinarily is the case. The OBR is actually very small. It's about 30 staff, and their role is basically auditors. So it's Treasury staff who create these forecasts. Invariably, they're wrong, and then that's approved or reapproved by the OBR. So they certainly do have a role. Now, obviously, the Chancellor today, I think, is getting rid of the Office for Tax Simplification. I don't know whether that's yet going to be something the government's going to be doing in the future. But no, obviously, Robert Choate sort of really brought up the profile of the OBR when that was first created, and its cachet certainly improved. But I mean, they're as fallible as any other macroeconomist.
What did you make of scrapping the Office for Tax Simplification? Was that the first quango that you wanted crushed by this new administration?
Well, I wouldn't say it was number one. I mean, I have done quite a few elongated consultation responses to them, so it does feel slightly wasted. But I mean, their contribution is relatively limited. There seems to be some good people on it, but
they haven't obviously succeeded in simplifying the tax code since their creation.
No. So it's sort of a justification for their elimination, I suppose.
Let me come back to the audience in the room. Yeah, if we can get the microphone just here again, if you wouldn't mind introducing yourself for the benefit of our viewers.
Thank you, Hugo Jai from the newspaper. Today's fiscal statement looks like broadly a victory for the IEA and TPA view of the world. You're clearly pretty pleased, but are you in any sense anxious that now many of the policies that you guys have been arguing for so long are being enacted, are being put to the test? What happens if it all goes wrong?
It's a great question. I will take that to each of my panellists at the moment. I was reflecting on this. I actually said to Andrew before we went live, it's to some degree a lot more comfortable to be opposed to everything that's happening in the world and sort of saying that anything that goes wrong here can't be pinned on anything we've ever written or suggested or floated. So, and if things go well, they would have gone even better if we'd been listened to. But I think it's a bit difficult, isn't it? I'm not suggesting that the government and the IEA are completely simpatico. We were highly critical of the energy price fix, for example. But it would be a bit odd, I think, for a think tank to resent or regret that an administration was adopting its policies. If it turns out that these don't work, I think the IEA's got a lot of hard thinking to do. But I presume think tanks of any colour or complexion would want their ideas not just to be listened to, but to be enacted. And although I'm sure that won't happen across the entire swathe of policy, insofar as it does, my view is that the IEA should welcome that. And we want them put to the test. We don't write policy ideas just for them to sit on the shelf. We write them in the hope that one day they're enacted. But Andrew, do you agree we should take the same approach?
Well, I guess I'm sufficiently grumpy to be able to identify plenty of things that I wish they'd done that they didn't do, and to be, I didn't like the energy price package, for example, which is the single biggest measure which we have here. So that's quite a significant factor. Look, my view is that the things which they're trying are, by and large, worth trying. It's worth trying having some tax reductions and not raising taxes in the face of having a recession. It's worth trying reforming the planning system and those sorts of things in order to try to see whether you can raise longer term growth. Not everything they will do is going to work. Some things are going to work and some things won't. But if you don't even try, then in this kind of situation, I think that's kind of weak in the part of government. So my view would be, yeah, let's have a go at all these things. I don't have any strong confidence that every single thing is going to work, and I think they would probably end up doing some things that experimenting with some things that I don't approve of, as well as things that I do approve of. But this is a situation in which we've had fairly stagnant growth for more than a decade. We got trapped after the Great Recession with feeling unable to engage in much of the way of policy experiment because any kind of change was going to result in huge house price crashes or mass defaulting or those kinds of things. And I think it's past time we had a go at doing something else. So I would say that it's well worth a try.
Duncan, what do you think? Nowhere to hide now. Much more comfortable for the Taxpayers Alliance to be blaming everything on not being listened to. Now, potentially you are being listened to.
I suppose you're right. I mean, it's right. It's easy to oppose. I'm going to kind of echo, your comments as well. I would say that critics obviously will come out of the woodwork further down the track. Now, let's say, for example, the 2.5% target for GDP, which the Treasury is going for. Now, if it's not quite met, then necessarily critics will say, well, the goalpost needs to be revised to some kind of new metric. So I suppose the definition of failure or failures will be all around us, depending on what our opponents say. But yeah, I mean, as Andrew said, I think it's worth trying.
Julian, what do you think? We're on the hook for it now. If it doesn't work, it's your fault and mine, my friend, isn't it?
Oh, well, fair enough. It's a nice problem to have that you might be blamed for major policy changes. But the key point is those policy changes, I believe, are the right ones. There has been an enormous amount of negative commentary on everything that's been announced over the last few weeks from the sort of the economics commentariat, the establishment, whatever we like to call them. But very little of that has been constructive. It's just sort of identifying the risks and not mentioning at all the potential upside. So I'm known as a reasonably optimistic economist. I'm very much hoping that over the next few weeks and months that'll be borne out in the economic data and ultimately in how the markets view all of this as well.
I just trust that people will be as keen to credit think tanks if things go well as they are to blame them if things go badly.
In advance of things going badly. Well, I'll lob in a first criticism. I think 2.5% long-term growth rate's insufficiently ambitious, actually. So I think that should have been nearer 3 or something. Let me just take Rory at the back, then I'll come back to you, Tim. Wait for the microphone if you don't mind.
So we've heard a bit about how most of the tax announcements are stuff that's already been announced, and indeed they're not rises either, they're cancellation of cuts. They're cancellation of rises, yeah. They're not cuts, wrong way around there. So you can consider it as the direction of travel is changing rather than we're at the place where we want to be. How much further do you think there needs to be change like this in order to not just change the direction of travel, but to get where you want to be?
Interesting. Andrew, let me start with you, because you were highlighting in your opening remarks that, quite a lot of this is sort of fairly unremarkable because we've actually, just cancelled rises. I've been thinking this in terms of a change of trajectory in terms of the total tax burden, but has it actually just mainly been today hitting the pause button rather than actually changing trajectory?
I think quite a lot of it is that, but I do think that there's a kind of important philosophical switch as well of kind of not bowing to the people who say you have to do this and that. I don't think it's that strange an idea that when you have a recession you spend a bit more and you cut taxes a bit. That's worth trying. The measure of these things isn't going to be that. It's going to be how things work over the longer term. Now, I would say that you're going to get more than people anticipate almost for free here. So
more of what? Sorry,
more increase in growth over the long term than people are grasping will come for free, because I don't buy the story that the natural situation of the UK economy was only 1.5% GDP growth per year. That kind of secular stagnation story, I think, rather than that being a fundamental feature of the economy, was a reflection of us getting trapped in a certain situation after the Great Recession. So we chose not to allow the reallocation of capital that would have happened if you had the banks going bust or some kind of alternative approach to that, the natural rises in interest rates which there should have been in the late 2000s prior to the Great Recession, which might have led to house prices falling and that kind of thing. So we chose to freeze the economy where it was so as not to have the short-term disruption. Now that's all very well, but you shouldn't assume that that came for free. And one of the consequences of freezing things in that way was that you then ended up with a stagnant period. Eventually, the imbalances that you locked in place through your macroeconomic stabilization policies and other kinds of interventions would have been worked through, but it's very slow. Now, now that we have this period of fairly high inflation, it's unpleasant in its way, but one of the consequences of that is going to be a more rapid working away of some of those imbalances. You're going to see, as a consequence of a period of increased inflation, that some of the debt falls away. The increased interest rates as a consequence of high inflation are escaping us from a near zero interest rate trap. The policymakers are being forced by the fact that we've had this period of very low growth to experiment in ways which they hadn't in the past. So we're getting lots of changes of that sort. That's one set of things. We will also at the same time get some other things for free through things like the Russo-Ukraine war will resolve itself. So we'll get something out of that. We'll get some more COVID things, post-COVID recovery. We'll get other.
So you're with me.
New
3% would be a more realistic.
Well, I'm not sure about that, but I do think that of that switch from 1.5 up to 2.5, it's perfectly reasonable to think we might have got to 1 3/4 or 2 just almost for free. And so the trust things I think will make some effect, but actually there is quite a high likelihood that she will be able to look back and point at things and say, oh, look, the growth rate has gone up by quite a lot. You should credit me with that, when actually probably most of that effect isn't going to be down to policy at all.
Duncan, on the point raised there, do you think that this has really just been a pause? You I think, with ongoing horror at the TPA, we're looking at this ratchet effect over many years of taxes just tending to edge up, not spectacularly dramatically in any given year, but that was tending to be the drift. Is this putting that into reverse or just hitting the pause button? And do you think the government will now be sort of looking through for each future mini budget, fiscal event, maxi budget, what else they can do on top of this? Or is this just going to be a kind of, we've done it now move on to the supply side reform?
Well, I really hope it hasn't, the government hasn't sort of atrophied at, where are we now, 4:30 on this day after the budget. So a bit more radicalism in the future. I mean, look, again, what happened in, when was it, March time? The sort of the spring statement with the equalisation of thresholds between income tax and national insurance for employers, and employees rather, not employers. But a lot more radicalism in the future. I mean, there's an excellent document I can recommend those at home to read called The Single Income Tax, published in 2012, which lays out exactly how to combine those two taxes on labour in the future. So yes, I mean, if that was to be a regular system to do a dose of radicalism each budget, that's very welcome. But the indication, I think we're all sort of broadly on the same page here, is that this seems to be the start of something a bit more optimistic.
Julian, do you echo that? Do you think that this is just sort of the first salvo in a new game of economic chess that the government is now going to consider all of its future moves about being maybe not just tax reductions, tax simplifications? I mean, we're talking about the abolition of the Office for Tax Simplification, but the Chancellor pledged we don't need it anymore because that thinking is going to be wholly embedded in government rather than being at arm's reach from it. Are you expecting this to be the start of the journey, or have we sort of seen the big bazooka?
Yeah, well, I think arguably this is the second salvo, the second bazooka, the first one being the energy price guarantee, which is a policy I don't think anybody really liked. As I've said, I think any half-decent economist could have come up with something that was, better targeted, more efficient, and potentially a lot cheaper. But I think the plan they've gone for at least does, significantly reduce that huge overhang of uncertainty over both households and businesses. And if energy prices did remain high, then it's probably best that that risk is borne by the government and ultimately the taxpayer, rather than expecting individual households or businesses to pick up the bill. So that first salvo, I think, was very important. The second salvo today, a bit more imaginative with all the stuff on tax, but also there's very important supply side reforms. But there's no doubt at all that there's more things to come. Apparently, there's still going to be another budget later in the year, a proper autumn budget with the full OBR forecast alongside it, and then presumably another budget in the spring, and then a whole rolling program of supply side reforms to do with removing some of the regulations we've inherited from the European Union, getting Brexit done. I know that's something that Boris Johnson claimed to have done, but clearly with the Northern Ireland protocol not yet fixed, that still needs to be completed. So there's going to be a rolling program rather than a moment when we say that's it. So this is, I think, a very good start, but there's an awful lot more work still to be done.
Sure. I know our friends from the Telegraph wanted to come in for a second bite, but I will give people a first bite first, if that's all right. But I will try and get everybody in. If you haven't asked a question and want to, try and I'm surveying the room. Yeah, please, again, introduce yourself, if you would.
Jack from The Sun. Since the US President tweets about trickle-down economics, there's been a sort of big debate about that, and after today's budget, there might be criticism that that is the approach which Liz Truss is going for. How would you and her best rebut that?
Okay, well, Andrew, you're presumably just going to say your article in the Telegraph the other day.
That's right. That would be.
You might want to give a very, very short précis of it.
So. Trickle-down economics means that you think that the best way of helping poor people is by helping rich people, so that the rich people's increase in prosperity then feeds through the money they spend, the investment they do, into jobs for the poor people. Now, it's often said that nobody actually ever advocates that. There may have been a few people who would advocate that in the context of early 1980s 12% unemployment. It might be at that time that there were people who said, look, the best way of helping an unemployed person is to get them a job, not to raise their benefit levels. So if you don't increase the benefits, maybe you increase their incentives to get a job or something. So it might be that there were people who thought such a thing. It manifestly isn't anything to do with Truss's approach. The main way in which Truss is helping the poor people is by this absolutely massive energy package, tens of billions, maybe hundreds of billions of pounds over a couple of years. So it just seems to me to be absurd to suggest that the main thing she's doing is anything to do with trickle-down economics at all. It's not that I think that trickle-down economics is some sort of slur, particularly. To me, it's a bit like saying, well, why is she adopting the policies of Selwyn Lloyd, who was the Chancellor in the early 1960s? Well, the reality is she isn't, right? So, I don't know, other than it's nothing to do with trickle-down economics. In the US context, of course, Joe Biden isn't talking about Liz Truss, he's talking about people in the US. And there would be probably people in the US who would say, oh, well, you should be cutting very high. We don't want to, it's okay, because in the US, the top rates of tax are much lower than they are in the UK for people. And so in the context there, it might make sense. It's nothing to do with us.
Duncan and Julian, very quickly. this distributional effect, there's a brilliant rather elegantly edited clip on me on the Sophie Ridge show earlier, in which I apparently say, if you worried about the poor, you wouldn't like this. But what I actually said in the context of it was, obviously, if you look at this just spreadsheet, how much does somebody on 20 grand a year gain against somebody who's on £500,000 a year as a city banker, the number would sort of seem that you're not doing enough for the poor people. The government, well, the Prime Minister at least, has been very clear that she wants to get away from that sort of distributional analysis. Andrew was saying earlier, if you generally cut tax in a sort of broadly sensible, broad brush way, oddly enough, those who pay the most tax will get the most pound benefit. But how do you think, in the narrative argument that groups like the Taxpayers Alliance and I guess the IEA put, we sort of try and get off that distributional basis? Because the assumption for many people is, well, if you care about the poor at all, you must be hoping that the bankers' bonuses filter down to their butler or something. That seems to be what they're interpreting the economic strategy must be.
Well, I think there is almost a certain tyranny about a demand for distributional analysis. Torsten Bell and who leads the Resolution Foundation and other members of the dirigiste establishment in this country were, spitting feathers about some of these works. A couple of points I've made. First of which is that I think it's something like 30 million people, so 30 million workers will be affected by the income tax cut and the basic rate going from 20 to 19 pence at the start of the next financial year, so that's really quite substantial. But then getting to the particulars of distributional analysis, obviously the bottom deciles to the bottom 10% of earners, overwhelmingly those households either won't be in work or be part-time workers or approaching retirement, so therefore their incomes are going to be substantially reduced, but topped up by various other measures, as I was alluding to earlier, within the benefit system. So yes, if you're just looking at the distributional analysis of one particular tax change, i.e. abolishing additional rates, but also changing to the basic rate, then that is a metric to look through, but it's a very partial one.
Julian, what's your take on that? That's what sort of, and it does seem that the government, I guess, it's them to judge political risks, not a think tank, seems to be willing to take this on the chin, right? Rather than sort of making sure that every single tax is sort of manipulated in a way that they can show that a particular cohort as a percentage of income has done better than some other cohort. They seem to be saying, well, let's go for it. The benefit system should be helping, or the energy price cap should be helping at the other end of it. But do you think they've got away from this distributional modelling?
Well, I certainly hope so. I think it's a variation of this sort of abacus economics or bean counting that Truss and her team have been criticising. But even on its own terms, it doesn't really make sense. You often see the impact of tax cuts expressed as pounds and pence, but that's not normally how we think about the distributional impact. We think about the impact on household budgets or income in percentage terms. And if you take, for example, the energy price cap, yes, but by a small margin, higher users of energy who tend to be a little bit better off are gaining more in cash terms than low users of energy. But if you look about the impact on as a percentage of household budgets, the energy price cap is very progressive. I mean, it's providing a big benefit to people who spend more of their income on energy than others, and those people tend to be poorer. So even if you are going to focus narrowly on the distribution of impact, then actually you can find some big positives in what the government is doing. As for this broader discussion about trickle-down economics, I share the frustration of others on the panel about this. I mean, to the extent that trickle-down economics means anything, it seems to be about the demand side of the economy. You know, you give more money to rich people in the hope that they will spend it, and that will somehow feed through to poorer people. Now, that in itself doesn't make a lot of sense. If you want to boost demand in the economy, you should give more money to poor people because they're more likely to spend it than to save it. But that's not what any of this is about. This is about boosting the supply side of the economy through, for example, tax cuts. And yes, if you cut taxes, then more of the benefit will go to people who normally pay more tax to begin with. So in that sense, it might appear to favour rich people. But the whole point is to boost labour supply and employment and investment in the economy. And then stronger economy provides that bigger cake. It's more wealth, and then you do other things to redistribute that cake or that wealth if you want to. But criticising today's budget as trickle-down economics, I really think makes no sense at all.
I know our friend from the Telegraph wanted to get in. If there's any other questions, and I'm conscious we're going to run over time. I've got one or two from YouTube, but yeah, have another bite at the cherry.
Thanks very much. I'm really impatient, so I'd like to know how long it takes before supply-side reforms take effect. Are they quite slow to have an impact? And also, I wondered with the tax cut side of things, is the government sort of driving with the handbrake on when it's still got the thresholds frozen, which are going to increase a lot of people's tax?
Duncan, let me start with you in that regard. So the supply-side reforms, we don't know the details of what they're going to do on planning or in these investment zones, but how quick's it come on stream? Days, weeks, years? And on thresholds, do you think that was a real missed?
On the first part, can't give a clear answer. I mean, the modelling sort of indicates that sort of serious change happens within a few years' time, but we'll have to wait and see. Obviously, some measures have gone ahead today. Stamp duty change, but there'll be sort of various iterations over the next few weeks of various bits of legislation. In terms of the thresholds, yes, I mean that's an open goal. Linking that to inflation, I think, is a pretty axiomatic thing, which the government hasn't done. So yes, hopefully in the future that will change.
Andrew, on the supply side stuff, how long does that how long does it take to tick through?
Supply side measures have enormous variability in how rapidly they come through. So some might only take, a year or 18 months or something. I mean, I could imagine maybe if you change some rules about fracking and you got things quite rapidly, then it's once you start getting the fracking online, then you have some kind of effect of that. So maybe that's 18 months or 2 years or whatever. Other things, if you change the way in which people, if you change the arrangement of your education system so that you then get a different set of skills evolving through time, I mean, that's going to have some impacts for the next 40 or 50 years. So labour market reforms maybe have some intermediate thing. They might have some impact. They start over 5 or 10 years and then maybe they carry on for another 20 years after that. So you have enormous variability. There's not one rule.
I guess those who have a partisan interest in the Conservative Party, I'm not one of those, but might take the view, is there a worry here that they put together these wonderful reforms and the benefits only start kicking in the day after General Election Day? I mean, that shouldn't be an economic worry for those who are interested in what works, but you could understand that being a concern from their party political side.
That's absolutely a political concern. As I was just saying earlier, I think actually what will happen is that they will get quite a lot of the growth boosts that come for free, which aren't to do with their policy, and then they will look quite good. They'll look sort of vindicated, it's perhaps slightly unfairly vindicated. The other flip side of the unfairness would be that actually they will probably have some impacts from the things which they do further down the line, at least if they come up with good policies. And a lot of that's a black box.
As well as when people open their pay slips at the end of November.
Yeah.
Okay.
Julian, what's your thoughts on that? Is it sort of, we're interested in the economics, not the politics, but you can imagine that the politics of it will be guiding some of the government's thinking. Is it sort of almost too late on some of the supply side stuff from their point of view? Not that it ever would be from ours.
Well, I think if you look at the whole package. last couple of weeks is the energy price guarantee, which is mainly actually a policy about the demand side rather than the supply side. And I think, as I said earlier, that is enough to prevent the deep recession that might otherwise have happened. So that provides a bit of breathing space for the supply side measures to work. Clearly, the supply side measures will take longer to come through in terms of sort of tangible economic benefits. And we're talking here, years, if not necessarily decades. But remember that, if you look, for example, the cuts in corporation tax or the cancellation of the increases and the additional cuts in income tax next year, that should start to boost people's willingness to work, actually, even before those tax changes come into effect. And certainly should make companies more willing to invest here, because they'll be looking forward to the taxes they'll be paying on future profits based on investment they'll be making now. So I'll be disappointed if this doesn't have some sort of positive impact on labour supply and also on investment, even before those tax changes are actually implemented. But if we do have to wait until next financial year for those benefits to come through, politically at least that's still in time for the next election. And in the meantime, as I say, we've hopefully avoided the deep recession that might otherwise have happened.
Let me just finish, each of you, and Julian, I'll start with you. A question from Matt Carter on the chat. This is something that was flagged today, but we're awaiting the details on these investment zones or enterprise zones, where a range of regulatory liberalisation is promised. The Chancellor gave us a sketch of that. Is this a good economic strategy, or is this just dislocation? I mean, I only half-jokingly said earlier I'm in favour of enterprise zones, but I only want one of them. I want it to be called the United Kingdom, rather than piecing them all together. Or is that a bit of cakeism on my part? And actually, is this putting sort of flesh on the bones of the levelling up agenda, that there are areas that could actually benefit, and the net benefit to UK GDP would be positive, rather than just companies relocating from a non-enterprise zone into an investment zone? What are your thoughts on that?
Well, I think in this case, I'm largely with you. It does beg the question: if lower taxes and easier planning regulations or whatever are right for one part of the country, why not another? So my preference would be to scrap the idea of special enterprise zones and, as you say, roll out the programme across the whole United Kingdom. Against that, though, 2 points. I think on balance, this is a good idea. I mean, first of all, it does lower the average level of tax and burdensome regulations across the country as a whole. So overall level of activity in the country should increase. And secondly, there's actually going to be quite a lot of these special enterprise zones. I think it's going to be at least 40. So it is actually going to cover large parts of the country. And to the extent it is targeted at those areas where there are the most unused resources, the most unemployed people, the most poorly used land and property and so on, then contributing to levelling up agenda at the same time as boosting the overall level of economic activity. I think this policy is probably a good idea, but I share your sort of initial scepticism. If it's good for one part of the country, why not just do it for the whole?
Your take, a distortive measure or a boosting measure, or a bit of each?
Look, I think that regional policies of various sorts are one of those things that one lives within a country. I mean, we have, you have different amounts of subsidies for your local authorities through local taxes and subsidy systems, local enterprise zones with different boosts for those. I think that's probably fine. I wouldn't be particularly optimistic about these having a large effect. And I think one of the I'm quite pleased that they're in a lot of places rather than a few, not because I think that I'm, again, that optimistic about them having a large impact, but because I think that it could be very difficult to guess exactly where you want to boost the economic activity, particularly when we're going to have such a significant shift in the geographic structure of economic activity off the back of working from home and the post-COVID world. So I think that we don't any longer know exactly where in the future all the best places for activity to be based are. So it's worth a try, but I mean...
Duncan, what's your take on this? So when the free ports, which I guess was an iteration of this idea, came out, I kind of said, well, build them wherever you want, and then just agree that the zone will move inland by about 10 kilometres a year, and before you know it, you've got the whole country covered. How do you think we should be approaching this?
I don't have a particularly strong view, to be honest. I think I'm generally slightly more on your side. On the other hand, tax competition is good. As Julian says, importantly, if it lowers the average tax burden across the whole of the country by virtue of this, I think that's that's a net benefit, but I'm not particularly excited about it either way.
Okay, well, I've overrun our allotted time by about the same amount that the government has overrun its historic budget deficit. So I should bring matters to a close. For those watching you on YouTube at home, if you've enjoyed the broadcast, please hit the thumbs up. If you're not already a subscriber to the IEA London YouTube channel, please hit the subscribe button and the notification bell. That will mean that you get to hear about all of our upcoming videos. And for those of you in the room, I hope you can thank the IEA and TPA staff who have put on this briefing event, and in particular our panellists Duncan, Andrew and Julian in the usual way. Thanks very much. Over and out.